Have you ever wondered what a balance sheet is? Well, in today's video, you're going to find out just that. Insert cringy YouTube intro. Alright, so let's start off with the basics. I'm pretty sure most of you guys know what assets are, but if not, just in case, assets are things that are income producing or have value. So think of cash, think of real estate, think of if you're, just think of tangible assets. So either stocks, investments, money, real estate. I know I just said those two. Stuff like that. Stuff that you can either sell right away and get cash. Like anything you can liquidate that has money in it, think of that as an asset. Anything, and then let's go to total liabilities. Liabilities are the opposite of an asset. So think of a car payment or bills or debt accrued from financing and stuff like that. So basically, when you look at a balance sheet, and by the way, we're looking at NVIDIA Corporation, one of my favorite companies to invest in. I wish I had more money to put in there, but NVIDIA is a great example because you want a company that has ideally more assets than liabilities. Sometimes it's the opposite case, so there'll be like a growth stock that's newer and acquired a lot of debt to try to grow faster. But that's a lot more of a risky investment because if they liquidated everything, they'd still owe money. Ideally, you'd want a company, say like NVIDIA, which is still like a growth tech stock. You'd want them to have more assets. So if you look at the 44, which this is in thousands, so you would want to assume 1,000, 10,000, 100,000, a million, 10 million, 100 million, billion, 10 billion, and so forward. So this is over $10 billion. This is 44 billion, 187 million. So that's a decent amount of assets right there, but minus liabilities. So 44 minus 17. Let's say that'd be like what, 36, 37? No, I mean 26, 27 billion left over. So yeah, it'd be 20. Yeah, so close enough in the ballpark anyways. Incredible with maths. So yeah, leftover, it has quite a bit of assets left over, so that means it's a relatively safe. It's got a tad over double of what its liabilities are. I would like to see it. I mean, it's kind of stayed there pretty consistent. Man, that was really good back then. Man, actually, the 2020, they had a lot more. They had over 3 times the assets value. Oh, and even back then, that was even better. And so they've recently accrued a lot more debt. Um, hmm. Yeah. So, anyways, I was. I'm re-updating myself on the current balance sheet. But let's see, total capitalization. Those are basically the sum of all long-term debt and equity. So it's got some long-term debt in there. I'm gonna assume like real estate and stuff like that. Potentially common stock equity. So that's grown quite the years. Capital lease obligation. So it's stuff that's things like rent or hiring costs. Net tangible assets. So these are assets that are, I believe they could immediately liquidate. Or no, it's more physical. So like real estate, equipment, stuff like that. So working capital. Working capital is cash, unpaid bills, kind of stuff like that. I mean, it's kind of a mix of assets and liabilities. It's just more short-term stuff. Invested capital is pretty straightforward. It's just the capital they have invested. So they have been increasing quite a bit of their investments lately. Tangible book value, I mean, 19 million or 19 billion. My bad. Yeah. Total debt 11 billion. It's gone up quite a bit, especially in the last year. I mean, it's almost doubled last year. I mean, it tripled from 2020 to 2021. Yeah, shares issued, or when they, I mean, it's when they issue shares. So when they sell off to raise funds. Ordinary shares number. I'm guessing these are, so it looks like they bought some, then they sold some, and they bought some, so they kind of just buy and sell. It looks like a decent amount. Treasury shares number. That's a bit of an odd scoring. Yeah, some of these are less relevant than others. I mean, if you're just wanting to look at the basics, I would just say compare their total assets to total liabilities, and the safe bet is to do anything that's over double. So if their assets are over double and they have cash on hand to handle any short-term debt, I would say it's a safe bet, because if they don't have the cash with short-term debt that they have to pay off, that means they're going to have to raise funds somewhere or liquidate some of their assets, which if those are also like invested or, on longer term debt, then that can be a bit more of a hassle to get rid of. So a safe bet, the basically the better the assets and the more cash on hand they have, the safer the investment bet is. I will be making other videos in the future on how to read an income statement and cash flow. So if you're interested in learning more about how to properly look at the fundamentals of a company, then like and subscribe and share. I'm trying to grow and better myself on here too. So if you have any critique or anything you want to say to me, if I messed up on any of these, by the way, feel free to share, because I'm all about learning and growing as well, as much as I'm trying to teach and share what I know. I mean, I'm not an expert by any means. So yeah, again, if you like the video, then like, share, and subscribe. It'll mean a lot. Yeah, it'll make my day, honestly. So yeah, you guys all have a great rest of your day or evening or wherever you're at in the world. See ya.